One of the pros of trading Forex that I listed earlier in this course is the low amount of startup capital required for trading. In order to open up and maintain a new Forex trading position, you're only really required to put up a small amount of the capital that your trade is worth. This capital is called your margin, okay? And if you are wanting to buy $100,000 of worth of the, let's say the USD CAD pair, you do not need to have the full amount of the $100,000 deposited into an account with your broker. You really only need to put up a portion of that, probably around $3,000. And the actual percentage of the capital required is definitely going to vary depending on your Forex broker, your CFD provider. But margin is not a fee or a transaction cost. It is a portion of your account balance that the broker is going to set aside or is going to be locked for the duration of your open position in order to ensure that you can cover the potential loss of the trade. Once your trade is closed, the margin that was set aside is now unlocked and is now usable again for you to be able to open new trades. Every position that you open will have its own required margin amount that will need to set aside from your main account funds or locked for the duration of that trade. And margin is always expressed as a percentage to the full position size of your trade. To apply this concept, a little further, because we like to talk about how these concepts actually affect us and what that looks like for us as retail traders, we're going to look at the breakdown of a typical dollar CAD margin requirement of assuming a 2% requirement of a margin, which is typical to buy or sell this $100,000 of the dollar CAD without leverage would require the trader to put up the whole $100,000 in cash account funds, which is the full amount of the position. But with a margin requirement of 2%, only $2,000 of the trader's account funds would be required to be locked or held to open and maintain that $100,000 position. The same thing applies for these other two examples. On a $10,000 trade size at a 2% margin, you would only be required to have that $200 locked away out of the entirety of your trading funds while that trade is running. And if your trade size on a trade that you're placing, whether it's long or short, it would require at 2% for $20 of that $1,000 to just be held aside in case you lose that trade. That is the broker's security deposit, if you want to think about that. And that will be unlocked at the time that the trade closes, assuming you win or break even. Now, leverage is also a very common trading tool in Forex. And leverage is basically borrowing a certain amount of money or capital, which is fronted by the broker, in order to invest in a currency exchange. Now, leverage allows the trader to control larger positions, which everybody loves, with a smaller amount of actual trading funds. And the size of leverage available varies with broker and legalities based on the country of your residence, as well as which Forex pair you're trading at the time. Forex trading does offer a very high leverage for the initial margin requirement, and a trader can build up and control a huge amount of money because of the leverage that is offered through Forex. So if a broker offers, or you choose, a leverage of 1-to-1, if you are placing a $100,000 trade, you're going to be required for that $100,000. On a 2-to-1 leverage on the amount traded of $100,000, the required margin is $50,000. On a 50-to-1 amount of leverage, and again, sometimes you may have this option, sometimes you may not. The highest you might be able to get is 33-to-1. But assuming you live in a place where you can have the higher leverages, you can pick the 50-to-1 or some of the higher leverages available. Again, on the amount traded of $100,000, for at a 50-to-1, you're required for a $2,000 to be locked away there. For at 100 to 1 on $100,000 amount of a trade, you're required for $1,000. At a 200 to 1 at $100,000, you're required for $500. And at a 400 to 1, you're only looking at $250. And that is one reason why people love the Forex market, because again, sometimes for a very small amount of money, you can control large amounts of trades. You can, and it really leverages your account, so that you can compound your money a lot faster. And that is a lot of times why people are drawn to trade the Forex market.